The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
A warm welcome to this Monday edition of Scorebox Europe. I'm Steve Sedgwick with Karen Cho and Juliana Tattelbaum, and these are your headlines. A tableau of tyrants. US Senator Richard Blumenthal hits out at leaders attending China's military parade, telling me at the Ambrosetti Forum that the US and Europe must present a united front.
This kind of axis of upheaval is probably the most direct and imminent threat to freedom and democracy in my lifetime. We need to come together, Europe and the United States, more than ever.
Japan's Prime Minister Shigeru Ishiba resigns after less than a year in power, following a series of election defeats. But the Nikkei pops on expectations his successor could usher in broad fiscal loosening.
French Prime Minister Francois Bayrou faces almost certain defeat in today's confidence vote, throwing the government into crisis and raising serious questions over France's ability to rein in debt and spending. And a statement of intent. OPEC Plus surprises the market, unwinding production cuts and raising output by a further 137,000 barrels per day in October, as Saudi Arabia looks to reassert its market's dominance.
Very good morning to you both. I hope you had a restful weekend. I had a fascinating few days in Ambrosetti. I spoke to the world's largest investor, bar none, with the biggest fund going, bar none. That was Chatham House, so I can only tell you roughly what Mr. Fink had to say. But I also spoke to some of the key politicians on both sides of the Atlantic. And let me just come up with one very quick comment as well. Europe has multiple crises. Duh, that is not a big surprise as well. But Europe is finding itself needing to face crises in order, and so the reform of Europe to get its economy fit for the 21st century, to get its competitiveness back as well, that has been booted, and I won't say into the long grass, but certainly into the medium length grass or the medium distance grass as well, because the crisis over tariffs, the crisis over defending itself, finding the money to defend itself as well, these have taken preeminence. And once again, unfortunately, that is the problem for Europe as well, that the crises are queuing up, but the real solution to these crises, i.e. making us better and galvanizing this enormous economy we have with 450 million consumers, it's just taking way longer than it should do.
Yeah, let me just dovetail off the back of that. I'm so keen on hearing all the conversations you had over the weekend. But as we sit today, we talk about a number of key resignations and jobs in doubt. And we talk about a position in the UK from Deputy Prime Minister, a resignation there, to a vote of no confidence in France, to a resignation of a Japanese Prime Minister. I wonder whether this is the other side of the tariff turmoil, that you now have countries that have looked at domestic policy to try and rail against some of the international pressures are realizing that, look, they still have fractured politics at home and populations that have been under so much stress for so long. There really isn't the firepower, but there is certainly the determination of voters to get more back. And it's a real clash, I think, between the political establishment and the voter population.
I think your observation, Steve, just coming back to your opening comment, really interesting that Europe is really coming under fire for not being able to essentially multitask here when it comes to addressing the various crises
what I'm trying to
at
say,
hand.
yes. Multitask.
It also seems...
It needs to channel more woman.
Channel more woman, and dare I say, channel more United States.
That's not me being sexist to say so. I know some magnificent women in my life. Most of them live at home with me. And
work with you.
Wives and work with. And the ability to multitask is essential. That is exactly the key point.
It also stands in stark contrast, without making this, taking a political stance here, but to what the United States is doing. The Trump administration, whether or not you agree with the policies the Trump administration is taking, they are attempting to tackle border control, trade, national security, bureaucracy, all at the same time. And whether you agree or not is another question, but they are trying to tackle them all at the same time, which seems to be in stark contrast to what Europe is doing.
I think that's one of the issues, the multitasking, the lack of it. I think the other one is that somebody drained the bank account. There's all these requirements, but everything that's come before for previous decades, not addressing debt and just adding to the debt position and the deficit position. Now that we have true crisis on the ground in many countries, someone drained the bank account.
Let's carry on this conversation. It's a great one. I think it's the conversation for Europe if it is going to face down all these threats. Right, so the US economy added just 22,000 jobs in August, coming in sharply below expectations and raising further concerns over the strength of the American labour market. The unemployment rate climbed to 4.3% over the month. It was the first non-farm payrolls report since President Trump fired the former BLS Commissioner Erica McEntaffer. The week report has seen traders ramp up their bets for a Fed rate cut in the Fed's September meeting, which is next week, by the way, 16th and 17th of Sept, with 1 in 10 now seeing a potential 50 basis point cut next week. The market now appears to be pricing in 3 rate cuts by the end of the year, with the CME's Fed Watch tool showing a 64% chance of rates standing at 3.5% after December's meeting.
US Treasury Secretary Scott Bessent said he is confident the Supreme Court will uphold President Trump's so-called reciprocal tariffs, but warned of huge disruption if they have to be unwound. Bessent told NBC's Meet the Press a delayed ruling striking down the levies could leave the Treasury having to repay up to $1 trillion in tariffs that would have already been collected. Bessent said there is a backup plan if the court ruling does not go their way.
I am confident that we will win at the Supreme Court, but there are numerous other avenues that we can take. They diminish President Trump's negotiating position, but there are numerous in terms of, and remember, this isn't about the dollars, this is about balance. The dollars are an after amount.
The simultaneous challenges from geopolitics and trade were in focus at the Ambrosetti Forum in Chernobyl last week, with calls for a boost to Europe's defence capabilities and further support for Ukraine. Now, who's Richard Blumenthal? I want to just explain to you who this senator is I spoke to. He's a Democrat, he's 79 years old, but he is one of the absolutely key gentlemen working with his opposition politician, with the Republican Lindsey Graham, to push a move through the Senate which forces enormous tariffs on anyone who touches Russian product. And this is the pressure that's being put domestically on the president. The Graham-Blumenthal bill is one of the key pressure points on the administration domestically to toughen up the stance on Russia. Okay, now you know who he is. Now, I asked him whether a move by Washington to tighten sanctions on buyers of Russian product, i.e. crude, could end up hurting the US economy.
Not at all. There are problems for the United States economy, no question. The weak jobs report that we saw on Friday, the impact of tariffs in raising consumer prices. There are problems in the American economy and the danger of stagflation. And of course, I have opposed these increased tariffs. The president and I differ on that point. But I think that the bone-crushing sanctions that our bill contemplates and would impose would in no way threaten the economies either of the United States or Europe. Obviously, it would Russia. That's the target. These are not kind of broad-based sanctions, but aimed at, again, China, India, and Brazil and other countries. If there's any unfairness in the president singling out India, it is that it's only India that has been sanctioned so far for continuing to support Russia by buying its oil and gas.
What do you make when you see the pictures of a lot of authoritarian regimes in Beijing looking at one of the biggest military parades that we've ever seen in our lifetime? What does that make you think about the threat of these regimes, which the president hasn't been particularly tough on as of yet, joining together? Is that a threat for all of us in the West?
You know, I think the free world ought to be very alarmed by that tableau of tyrants that we saw, watching China display its military might. Kim, Putin, Xi, and of course, India participated in the talks. Iran was represented there. This kind of axis of upheaval is probably the most direct and imminent threat to freedom and democracy in my lifetime. Because what we see is a united front against European democracies and the United States. And it means that we need to come together, Europe and the United States, more than ever. Not just militarily, but economically and politically, because the threat is not just in visible, tangible terms, but also the use of the internet to undermine democracy, the use of other kinds of subterfuge and sabotage, a direct and imminent threat to our democracy.
And do you feel, with that in mind, that the president also recognises that threat, or actually is blind to that threat, or is actually not facing that threat head on because of other concerns?
To be very honest, I think the president so far has failed to recognize that threat as fully and directly as I think he must. Xi, Kim, Putin, that alliance combined with potentially Iran, India hopefully can be wooed back away from it. It's not an aligned nation. But that tableau on that day of those tyrants who want to destroy democracy, they don't want to just weaken us, they want to destroy us. The president must understand it and act accordingly.
The greatest threat in his lifetime, that's what he says. I spoke to the European Commissioner for the Economy asking if the continent is doing enough to support Ukraine.
More has to be done, because indeed what we see now is less US engagement with Ukraine, with providing military support to Ukraine. Also just recently President Trump announced, unfortunately, also less engagement in Europe, in European frontline member states. So this just adds to the urgency of strengthening Europe's defense capabilities. If you look at Europe, we have every advantage over Russia in terms of our economic and financial potential, in terms of our industrial potential and innovation, in terms of population. So we must make these advantages count by strengthening our own defense industry and capabilities. And that's why we had come forward with this Rearm Europe Readiness 2030 initiative, foreseeing to mobilize additional 800 billion euros for strengthening our defense over the next 4 years.
Are you disappointed about that American pullback in support for those frontline countries, especially on the eastern flank, given the success that many Europeans walked away from The Hague thinking they had in terms of keeping the Americans engaged?
Well, obviously it is a disappointment, but maybe it's also not a huge surprise, seeing the general direction of President Trump administration and less engagement also in terms of Ukraine support, but it reaffirms a message that Europe needs to stand on its own feet.
I also spoke to Mr. Kapelius, who's the European Commissioner for Defence and Space, who gave this out. He was on, by the way, he was on that plane that got jammed by the Russians. He was with von der Leyen. Anyway, he gave his take on the outlook for spending on the continent after NATO upped its military expenditure.
Let's try to forecast what does it mean, 3.5% till 2035. Well, in my view, we can, just for simplification, we can say that, okay, during those 10 years, in average, we shall spend as Europeans around of 3%, of our GDP. Now less, but then we shall increase. Baltic states now are spending 5%. Let's take 3%. What does it mean? It means that per year, Europeans will spend 600 billion euros. 10 years, it means 6 trillion. Let's say that this is too optimistic. Let's stop on 5 trillion. It's a huge amount of money. Of course, not all the money is going to real, defense like equipment. Quite a big part of money is going to salaries, pensions, and so on. But according to NATO average, around of 30-40% of defense spending is going to real stuff. So it's trillions. The question for me is more of financial engineering, how to front load those money, because what will come in 2035 is a little bit too late if to calculate Putin's plans.
As the European Union looks to navigate the ever-changing political environment, I spoke also to Ireland's Minister for European Affairs about whether the bloc is moving ahead with simplification.
There's a lot going on, but there's always a lot going on. And Europe, some people said Europe is forged in crisis, and it has been over the years and continues to be as well. So the situation in Ukraine is obviously top of the agenda. security issues, which of course are national issues, but people work together at European level, very, very important. But the simplification agenda is being driven forward by the Commission in every single facet of its work. And certainly from an Irish point of view, when we take over the presidency next year, we want to see this as a big part of what we're doing, implementing and agreeing some of the proposals that are coming out from the Commission.
Let's take a look at U.S. markets and how things closed up on Friday, the big day of the week. A non-farm payrolls report coming in weaker than the market had anticipated. We ultimately saw all three of the majors end the session lower. The Dow Jones sinking about 220 points. The S&P 500 lost about 1/3%. And the tech-heavy NASDAQ ended flat. For the week, worth noting, the tech-heavy NASDAQ outperformed the other two markets, gaining more than 1%. We're going to talk a lot more about that non-farm payrolls report later in the program and what it means for Fed policy. In terms of Asian markets overnight, a lot of action there. The Japanese market outperforming, gaining more than 1%, modest gains elsewhere. But the big story coming from Japan, let's flesh it out for you. Prime Minister Shigeru Ishiba has resigned after less than a year in the role. The move comes after a national election setback in July with his ruling coalition, the Liberal Democratic Party, losing its majority in both houses of parliament. The ruling coalition had been expected to hold an emergency internal leadership vote on Ishiba's premiership today. Let's get out to our colleague, Kyori Njoji, who joins us now with more. First up, what happens now? And second part to my question, why are Japanese equity markets rallying on this news, given what it means for the political outlook in Japan?
Well, what happens now, good morning, is that we're into a very long, like a month period of political vacuum here in Japan, because the LDP, which is been in power for most of the last 70 years, is in disarray, and it needs to pick its own leader first. What happens after that is that it will be presented to Parliament, and because the LDP does not have a majority in either house of Parliament, it is by far, it is not a done deal that who they choose to be their party leader will in the end be chosen as Japan's prime minister. So we're kind of in uncharted territory at the moment. And this all started because the LDP lost very badly in the last election and an election prior to that. And I think the writing has been on the wall for the last 50 days about when he would resign. And on paper, Ishiba said that he's resigning because the executive order on the tariffs came out last week and the timing was right. But in effect, he was forced out by his own party. So this is a very fractured party. And although we've seen revolving prime ministers here in Japan, not at this level where the party itself is imploding and you have moderates pitted against conservatives. The market reaction, I think, is, as far as the equity market is concerned, fairly straightforward. The party knows that it was up against the opposition, who was saying we need more expansionary policies to try and get more money into people's households, into their purses. And the expectation is that maybe they will have to answer to that if they are to get anything done in Parliament. So that's why we've seen a big surge in the equity market. And, of course, helped by the weakening yen. The other factor, I think, is what happens to BOJ policy and the expectations for tightening. I mean, there are some houses that are saying, securities houses, that are saying that it might make it harder for the Bank of Japan to tighten. And that's why we're seeing most of the reaction in the bond market in the long end and not so much in the 2 and the 3 years. But one thing is for certain, this is yet another G7 country that falls into a political crisis, and quite different from previous times in Japan, because we could always count on the LDP to be in power. But with the party itself in disarray, I think there are big question marks about that as well. Back to you.
Kyori, thank you so much for bringing us the latest and helping us understand the market reaction.
Coming up on the show, the UK Deputy Prime Minister resigns, triggering a sweeping cabinet reshuffle. We'll have the details. Plus, French Prime Minister Francois Bayrou faces a crunch vote in Parliament today. And we'll have more from IAA Mobility in Munich, where Netta speaks to Volkswagen CEO Oliver Blumer and the Schaeffler CEO Klaus Rosenfeld. Those interviews coming up from 8 a.m. London time.
Phoenix Group has reported first half adjusted operating profit of £451 million. That is above expectations. The UK's largest savings and retirements business, which has almost $300 billion in assets under administration, said it is firmly on track to hit its 2026 targets. Always great to speak to Andy Briggs, who is the CEO of Phoenix Group as well. Andy, I'm trying to get Karen excited about her pension. Like anyone, it's kind of like, it's a hard ask as well. And I'm saying, no, this is really exciting. Have a look and have a look. I'm a man of a certain age, so I'm certainly looking at my pensions now as well and having a think as well. But the business is booming?
Business is going really well. We're delighted with our results today. Very strong operating momentum across both our pensions and savings and our retirement solutions businesses. And as you say, on track to meet all of our 2026 targets. So our strategy and vision to be the UK's leading retirement savings and income business, very much on track.
Let me just go straight there as well. The government is under stunning amounts of pressure. Rachel Reeves is in her job at the moment. We don't know how long she will be for because there's a lot of question marks about her effectiveness in the first year or so under this government as well. What are you hoping and what are you working with the government with in terms of getting better product out there as well and getting more access to how can I put it, to better pension outcomes?
Yeah, so one of the reasons Karen should be excited about her pension is in the UK, only 1 in 7 people are saving enough for a decent retirement. 6 out of 7 aren't saving enough. Only 10% are getting advice on their journey to and through retirement. So there's basically 3 key things we're working with government on, and they're engaging strongly and positively on these. One is pension adequacy. So we've got the Pension Commission being set up to review pension adequacy, so we get more than 1 in 7 saving enough. Secondly is filling that advice and guidance gap, and we've got the imminent launch of targeted support, which will help more and more people with help and support as they journey to and through retirement. And then the third area is getting greater access to private assets in order to give customers better returns on their pension savings.
Yeah, the problem is I would suggest that this government is making it a lot harder for you to do your job because the headlines on a regular basis are there's this big pot out there and we want a larger share of tax in it. And the changes to inheritance tax treatment on pensions has just been another, I wouldn't say a death knell, but it's been a bit of a blow for your industry, hasn't it?
So what we've actually seen is the tax wrappers in which people save has changed, but the amount of saving hasn't changed. So overall, the momentum in the market is strong. You've got an ageing population in the UK.
Yeah.
You've also got a big shift from defined benefit to defined contribution pensions. So our market is already huge, 3.5 trillion of assets. It's growing strongly through those structural drivers, and actually government and regulatory policy are more like tailwinds to our market. So Andy, in the doom and gloom, we're actually really positive.
Andy, love the answer, love your positivity. But Rachel Reeves taking a massive lump out of my wife's inheritance from me if I was to pass away, that is a massive disincentive for me putting more money in my pension, isn't it?
So what's important is you get the right advice and guidance to support your specific circumstances. For the vast majority of people, that inheritance isn't a particular concern for mass market ordinary consumers. For some it is, and then you need the right advice and guidance to help you plan your financial affairs around that.
But I'll go one more time. This is turning into the Personal Finance Show, and you know I love sparring with you on this one as well. But why should people of a certain net worth, and we've got lots of them watching this one, they're your clients, there are viewers as well, why should I bother putting more money into my pension when I know that if I was to pass away, my family is going to be absolutely trounced by this government?
So for the vast majority of people, that is not a concern.
For the vast majority of our viewers, it probably is.
Yeah, I'm not sure that's the case, Steve. But what you need in that circumstance is you need to get the right advice to get that optimise that tax position from your own perspective. Yeah.
To springboard you from personal finance to something a bit bigger than that.
Hook, Karen, quick.
To the macro situation, because the reality is, I think, for a lot of people looking at the uncertainty around job security, the international considerations, geopolitics, what the economy is doing from here, there is a level of uncertainty. And looking at the numbers today on retail net outflows, you say improved, but what are you seeing on the macro side that's having some sort of impact on the business?
Yeah, so I think the bit I probably worry about most from a consumer perspective is all the kind of speculation and uncertainty. I think in those circumstances, people will take less action to save generally, and therefore having greater certainty, greater clarity of direction, I think is important. So as a lot of people talk about the budget at the moment, it's going to be 2.5 months away. Let's not have lots and lots of speculation in the build-up, because it will lead to consumers taking less action.
You talked about greater access to private markets being one of the levers you can pull to try to, address some of the challenges in what people are saving for their pensions and the returns they're making. The flip side of that is there's obviously risk in giving access to ultimately individuals to the private markets, given issues around transparency. How do you think about balancing those risks with the potential return uplift you can get from investing in private markets?
So our focus here is to get our customers the best possible outcome and to give them a diversified range of investments. So what we've said is for our customers' savings, we're going to allocate up to 10% to private markets. So there'll still be 90% in public markets. We've set up a joint venture with Schroders called Future Growth Capital, specifically focused on this. Since launch just around a year ago, we've allocated £328 million to that investments into the private markets on behalf of our customers. So as part of a portfolio, I think it makes good sense.
Can I bring up the name change? Not the only company to do so, but
It's better than a budget.
Exactly. That's the most obvious one that we would go with, that it's not some sort of crunched down version, but Standard Life, so leaning back into the heritage of the business. Why is that significant? It really, does it give you any bump when it comes to the numbers?
Yeah, so this is really a logical step in the strategy in building out our business for organic growth, looking to focus on helping more customers on the journey to and through retirement. It brings our most trusted brand to the forefront. And from a colleague perspective, for example, it's a stronger employer brand as well, and just simplifies things down.
Andy, can I just ask you one more, again, macro question? Don't worry, I'll leave my personal pension situation alone for now as well. There is a vast amount of focus in our world about yield curve steepenings as well, and concerns about the longer-term gilt markets, whether our treasuries. It's not just a British phenomenon, it's a global phenomenon as well. Is that changing anything in your world, that people are now looking at longer-term, previously very safe bets for their pension and where they would allocate as they get older? Now they're raising big questions about it and its performance.
Yeah, so I think when the bond markets are jittery, that's obviously not great generally for different participants in the economy, for consumers. But if you have a scenario where basically, which is far more normal over history, where long-term interest rates are higher than short-term interest rates, that's actually good for long-term saving. The incentive is to invest longer term. It's good for the pension sector. So insurance companies generally do well with an upward sloping yield curve.